Okay, so I just hit the record button so that I'm going to be able to record this for the people that aren't able to make it today. But I'm really excited to have you guys here. This is so much fun for me. Today we get to talk about what I am calling the pyramid of investing success. And this is something I've been working on for some time. It's really brand new. A new idea that I want to share with you. It's something that we've been doing for a long time, but how I'm going to describe it to you is brand new. And the way that this came to be is years ago when my son was like 9, 10, 11, 12 years old, I was coaching his basketball team. And I wanted to become the best basketball coach I could be. These little kids running around doing push-ups and shooting hoops as 9-year-olds. But I bought the book Wooden, which was written by John Wooden. And I was looking for tips on how to become the best basketball coach I could be. And Coach John Wooden, one of the things that made me just crack me up about his story when I was reading that book is at the beginning of every year, the very first practice of every year, he would teach the players how to put on their socks and tie their shoes. And he had players on his team like Bill Walton and Kareem Abdul-Jabbar. Can you imagine Kareem Abdul-Jabbar sitting down with Coach Wooden the first practice of every year, and Coach Wooden teaching him how to put on his socks and tie his shoes? But the idea was, and I agree with this, is that it's all about the fundamentals. And Coach Wooden said that if we don't show people how to put on their socks and tie their shoes, they end up with an injury. They end up with blisters, and then they can't play. And that was inspiring to me. But the other thing that he taught in that book was what he called the pyramid of success, because Coach Wooden believed that you didn't just want to grow players to be great basketball players, but you wanted to teach them how to have a great life. And that's what the pyramid of success was all about. And that's what the inspiration was for the pyramid of investing success. And part of the reason that the pyramid of investing success was born is because it's all about the fundamentals, number one. But number two is that we did a live event here locally a couple of months ago. And I remember some of the questions that we had people asking were so fundamental, so basic, that I realize oftentimes as advisors, we get caught up in speaking a different language that people don't understand. I hope to both provide you the fundamentals, the foundation, and then I'm also going to get into some of the specifics and some of the research that maybe takes this to the next level for those of you that are looking for more of an in-depth understanding of some of these ideas. Okay, so why a pyramid? When constructed properly, a pyramid represents a structure that can withstand the test of time. It's strong, stable, built, and especially when it's built on a solid foundation. And then the pinnacle of the pyramid represents the ultimate goal, the achievement. Where are we headed? In investing, the same principles apply. Building your investment portfolio on a strong foundation with a focus on the fundamentals can help you weather market conditions and achieve long-term success. And one last thing I want to share with you as I pull up the pyramid. So I had sketched this out on a piece of paper. It's actually started on a whiteboard in my office. It's something I've been working on adding to for the last year and a half. But as I was preparing for this, I needed a better visual. So I asked my daughter, who's 16 years old, I said, hey, can you design me an image that we can use for the PowerPoint? And so she took my chicken scratches on a piece of paper and put together this colorful pyramid that I'm going to share with you. This is the pyramid of investing success. All right, so I'm just going to go through each one of these layers of the pyramid, and then we'll get into some more of the specifics. But you'll notice the bottom layer is the purpose. It's the why. And when we begin this whole process, a really great question that we like to ask people when they come in to meet with us is, what's the purpose of the money? Why do you have it? Before we get into the technical aspects of how to invest and how to create the remainder of the structure, it's really important that you ask this really simple fundamental question. What's the purpose of the money? Why do I have it? Because by understanding the purpose of the money, it's going to align every other decision that's made throughout the strategy that we talk about. So understanding what's the purpose of the money? Why do you have it? Ask yourself that question. The next part of this pyramid, this blue section here, is all about philosophy. It's all about how you think. Having a proper understanding of the markets and how they work. And what I've learned is that wrong thinking creates wrong outcomes. The biggest risk to someone's investment strategy is not what the market does. It's how you respond to the market during times of fear and greed. And Benjamin Graham said it this way. He said that the investor's chief problem, and even his worst enemy, is likely to be himself. To have a successful investment experience, it's absolutely crucial to adopt a well thought out investing philosophy. Intelligent investing, as I'm going to share with you, is not gambling, as some people like to think of it. And while it's possible to turn investing into gambling, which I don't recommend doing, I'm going to share with you an approach that I think is just very logical when you step back and think about it. There's a couple of key words here that I want to go over with you. There are wisdom, knowledge, optimism, courage, adaptable, and disciplined. Wisdom is defined as the ability to make sound judgments and decisions rooted in knowledge. And from my experience, there are plenty of educated, knowledgeable people who are broke. I recommend you don't take advice from these people. They've gathered the information, but they haven't applied it in an intelligent manner. I like the quote that says, "The aim of education is not knowledge, but action. Knowledge is gathering the facts. Wisdom is knowing how to take action on that knowledge." The next word is optimism. Optimism requires you to believe that the future will be better than the present. And when it comes to investing, it's a belief that businesses are going to continue to create goods and services that make our lives better. And when we become investors in businesses, we benefit from the growth and success of those businesses. The next word is courage. There is no courage without fear or uncertainty. And unfortunately, if you're going to see your money work for you, there is no return beyond inflation unless you're willing to take some risk. So you have to be courageous. The next word is adaptable. And the way I like to think about adaptable is babies are very flexible and dead people are very rigid. So we need to be flexible. As new information comes in, as we learn new things, we want to be able to apply that information. And so being adaptable is very important. And the last word is discipline. And many of you know that there's several quotes that I like around discipline. Abraham Lincoln said, "Discipline is the difference between knowing what you want now versus what you want most." Jim Rohn says, he says, "All men will experience pain, the pain of discipline or the pain of regret." He says, "The pain of discipline weighs an ounce and the pain of regret weighs a ton." And so if you're going to experience pain, let's experience the pain of discipline. Okay, that brings us to this next block in the pyramid, which is having a financial plan. Having a financial plan, and this is the reason that I invented the retirement budget calculator. I know that many of you are here tonight because you're using the calculator, and I appreciate you being here. But a plan is really your guiding light. It is the lighthouse on the shore. It's your North Star. Without a plan, I don't know if it's possible to have a successful investing experience. So a very fundamental part of having a good investment strategy is making sure that you have a really good plan. The next step is the tools that you use. How are you going to put your money to work for you? And you've got stocks, bonds, real estate, and cash. Remember, when you buy a stock, you're buying a part of a business. You're becoming an owner in a business. And when you buy bonds, you're essentially becoming a loaner. You're lending money. Real estate, like the country western song says, buy dirt. They're not making any more of it. And then cash is, I like to think of cash as a guaranteed way to lose money slowly. Cash is necessary to have within a portfolio, and it becomes even more important as you're making this transition into retirement. But the reality is that the Federal Reserve has a target for inflation every year. And by having an inflation target, what that means is that they want your money to lose purchasing power over time. And so if you take your money and bury it in a backyard, you're not keeping up with inflation. I would say that even if you keep the money in a bank CD or a money market account, you're probably not keeping up with inflation. Right now, those numbers look better than they have in a long time. But as many of you, when you go down to the grocery store or the gas pump, life is not getting any less expensive. So we've got to keep that money working for us. And keeping the money invested in an intelligent way is a way to make sure that hopefully you're gonna be able to alleviate the number one concern that most people have, which is running out of money in retirement. Okay, the next part is asset allocation. So once we have our plan, we're going to own stocks, bonds, real estate, and cash in some proportion. Asset allocation is what we're going to use to help us understand how much risk we want to take. And what I would argue is that if you're young and you're getting started, you want to take a lot of risk, especially if you've got a good job that's stable and good income coming in. That's the time of your life to take a lot of risk. What we find is that a lot of people, as they're transitioning into retirement, they're wanting to start scaling back from the risk. And I'm going to talk to you about how to do that and what that looks like. But asset allocation really is simply understanding how much do you want in stocks, bonds, real estate, and cash. And each of those decisions carry different risks associated with them. So part of this is your time horizon, part of it's the amount of risk that you're willing to take. The next piece, after we get past asset allocation, is global diversification. And global diversification really just simply means don't put all of your eggs in one basket. Diversification's been called the only free lunch in investing. And I've heard it said that the only people that shouldn't diversify are people that are 100% right all the time. It's really just spreading money across the different investments to help you reduce your overall risk. A question becomes how much diversification is necessary. And I'm going to show you towards the end of the presentation, I'm going to share with you the benefits of broad diversification versus concentrated diversification. Even looking at something like the S&P 500, which gives you exposure to 500 companies, I'm going to compare that level of diversification with even greater diversification. The next way as we move up the pyramid are low costs. Jack Bogle, who is the founder of Vanguard, said, in investing, you get what you don't pay for. And I think it's important to recognize that keeping costs low is really smart advice. As an advisor that walks life with people, one of the things that we often are able to do for people is help them reduce their overall costs. I would say you want to be stingy with costs, but wise with fees. And many of you probably, if you listen to the podcast I do, Sound Retirement Radio, I've referenced some of these different studies that have been done, but one of the ones that sticks out to me is the one that was done up in Canada by the Cyrano Institute. And their study took place over a period of 15 years. And there were a couple of key findings. And this is a quote from the report. It says, a report from the Investment Funds Institute of Canada highlights that on average, investors who work with financial advisors have nearly 3 times the net worth and 4 times the investable assets of those who do not. This observation holds across all age groups and income levels. The study goes on to say, also focusing on a subset of participants in both surveys, we found that the loss of a financial advisor between 2010 and 2014 was costly. Households that retained their advisor saw the value of their assets increase by 16.4% versus only 1.7% for the assets of households that abandoned their advisors during this time. And it's not just Canada that's done the study. Vanguard has done their advisors alpha that says on average, I had Todd Schlanger on the podcast a while back, and he's from Vanguard. And he was saying on average, people that work with an advisor earn 3% net more per year than people that don't work with advisors. Morningstar's done a similar study. BlackRock's done a study. InvestNet PMC, all of them have similar findings for people that work with advisors versus people that don't. You've probably heard that old saying, don't be penny wise and pound foolish. Or another way I've heard it say is, don't step over dollars to pick up dimes. Some people think that paying an advisor fee or not paying an advisor fee is helping them, but all the studies actually show the opposite. So while I'm a huge fan of the do-it-yourself community, that's the reason we developed the retirement budget calculator, what I know from all the research that's been done is that people that work with advisors end up in better situations than people that don't. The next level of the pyramid is once we've got the asset allocation, the global diversification, and the low cost, the next thing that we want to do is understand what attributes we want in a diversified portfolio. And those should include large cap stocks, mid cap stocks, small cap stocks, international developed stocks, emerging market stocks. And then if you're about to retire, you're going to want some fixed income, some bonds in that portfolio. And you're going to want short-term, mid-term, and long-term bonds as part of the asset allocation. Now, bonds up until recently had been they had been really challenging to own because interest rates were so low. But now that interest rates have reset, bonds actually look pretty darn attractive again. And remember, the reason that you own bonds in a portfolio is partly for income that they produce, but partly because they tend to be less volatile than stocks. So they create that buffer for you. They create that ballast for you for when stocks do get wobbly. Once we have our stocks and our bonds, the next piece is that we want to tilt the portfolios towards drivers of higher expected returns. And that would be drivers of higher expected returns would be things like small cap stocks, value stocks, companies that are profitable versus companies that are not profitable. And it would also mean on the fixed income side of things, on the bond side of things, to avoid junk bonds or high yield bonds. I like to think of when you get to retirement, you don't want to be taking unnecessary risks at that point in your life. Okay, so once we've tilted the portfolio, the next level comes rebalancing. Rebalancing, another way to say rebalancing is to buy low and sell high. That's what it forces you to do. And I'll never forget how this lesson was just really driven home in March of 2020. That was a time when there was a lot of volatility. The market was if you guys remember, there was days when the market would lose 10% and the days when the market was up 10%. That was when COVID was hitting and nobody really knew what was going on. And during that 30 days, the market was down 30% in 30 days. It was really a wild ride. But midway through March, I was rebalancing client portfolios. And at that time, what had happened because of all of the volatility, the value of the bonds had increased significantly. So when I went to rebalance portfolios, we had to sell bonds at a time when they're our safety net. And not only were we selling bonds, but we were buying stocks. And I tell you, that is not the greatest feeling in the world when you're selling your safety net to put more money in stocks. Now, hindsight tells you, oh boy, that worked out really good. You were selling your bonds when they were high and you were buying your stocks when they were low. But that's what discipline does, and that's what rebalancing does. It says that you're going to do what you say you're going to do, even when you don't want to do it. That's the key to being disciplined. The next one is taxes. With taxes, I found that a small hinge can swing a big door. Sometimes small changes to somebody's overall allocation can really make a big difference. Taxes are something that we're not going to get away from. Most of the people that we serve say, Jason, I don't mind paying my fair share of taxes. I just don't want to pay more than my fair share. And we live in the greatest country in the world, as far as I'm concerned. I don't mind paying taxes. But we also have a system that rewards people who are educated and knowledgeable as to how the tax system works. And so we want to try to put that on your side to make the tax code work for you as much as possible. And then the very top, the very pinnacle of this is freedom. When you follow the principles laid out in this pyramid of investing success, what we want you to do is experience freedom from fear, freedom from greed, freedom from worry, freedom to go out and spend your time with the people that are most important to you, doing the things that are most important to you. And the tagline of my first book, Sound Retirement Planning, was that we want you to achieve clarity, confidence, and freedom. And that's what this pyramid of investing success is really designed to do, is to point you in the direction of how do you achieve those things. Okay, so the next thing I want to talk to you about is investing volatility, because let me tell you, with investing volatility, nobody ever calls the phone is very quiet around here when we're making a lot of money in the market. When the phone tends to start ringing is when things get wobbly, when things get volatile. And this goes back to having a good plan. But one of the things I wanted to point out to you guys here, this picture, when I was preparing for this presentation, I went to artificial intelligence and I asked it to design me a picture of a bear and a bull riding a roller coaster named Wall Street. And this is what it designed for me. And I have to tell you, artificial intelligence, some people are saying that artificial intelligence is possibly going to be the greatest invention of all time, maybe greater than electricity, is what some people are saying. And many of you know that we now have our AI financial assistant, Finn, who lives within the retirement budget calculator. I'm really excited to be able to have that layer of intelligence available to you 24 hours a day, 7 days a week, to help guide you on this retirement journey. But volatility is important, and it becomes more important once you're retired. When you're still working, volatility is just noise, because you're dollar cost averaging. You're adding more money to your 401k every month, and volatility really doesn't matter. In fact, volatility is helping you to accumulate wealth because you're dollar cost averaging. But when volatility hits when you're retired, now you're reverse dollar cost averaging. Now you're taking money out of accounts that are falling in value. And that can really be a recipe for a disaster. Most of you know that one of the biggest risks you face upon retirement is having a bad sequence of returns right at the time you retire. So let's look at what the research tells us about volatility. This is looking at bear markets. So if we go back, we look at all the bear markets. A bear market is when the stock market declines 20% or more. So we look at all the bear markets from 1929 through 2023. And I highlighted in blue, in 9 of the 16 bear markets since 1929, investors who stayed the course made back their losses within a year, in 9 of the 16. But the key is that staying invested in times of volatility is really key to being able to come out of the storm on the other side and have a successful investment experience. And that's really what we're trying to achieve. One of the things that we built inside the retirement budget calculator is something called the buckets strategy. And you can find this in the retirement optimizer section of the calculator. And what the bucket strategy is designed to do is to help you understand how to diversify your money across time segments. The idea is that money that you need in the near term, in years say 1 through 3, that's money that you want to be relatively safe because that's where you're going to be drawing from. So you're going to keep that money just liquid in a money market account or maybe a high yield savings account or a CD. You just want to have access to that money because you're going to be drawing it down. And then the next bucket is going to be years 4 through 6. So that's money, again, needs to be relatively low risk because you're going to be drawing on it in a relatively short period of time. The third bucket would be for years 7 through 9. And then the last bucket gets you out to years 10. And so the question becomes, Jason, why 4 buckets? Why not 3 buckets? Why not 2 buckets? Why not 1 bucket? If you take all of the data in these bear markets that have occurred, and you just say, what I found is that on average, it takes approximately 3.11 years to weather a market downturn, to recover based on the data from the chart. And that includes both the period of decline as well as the subsequent recovery period. So the idea with 3-year buckets is on average, that's how much you've needed to be able to weather the storm. Now, could you create 5-year buckets? Sure. There was a time that we used to have 5-year buckets, but the issue became, or the problem became, for a long time, cash wasn't paying anything. So having a 5-year bucket really created a cash drag in your portfolio. And 3 years seems like a more optimal time. And one of the things I'd tell you about buckets, a couple of things about buckets, we're going to talk about these. And in fact, let me go to the next chart here, or the next picture. A couple of things about buckets, because the way that I think about buckets is much different than the way that most advisors talk about buckets. And the way that I teach people how to create buckets, the way that we do this for clients is much different than the way most of the world does it. So the way that most people do this is they say, oh, you have cash, bonds, and stocks in 3 different buckets. But what I suggest is that first bucket is your cash bucket. And then the second bucket, we create a broadly diversified portfolio, but we design that portfolio in a way that it's geared towards lower risk. So we have more fixed income, more bonds, and less stocks. So for example, you might have cash in the first bucket, 40% stock, 60% bond in the second bucket. The third bucket might be 60% stock, 40% bond. And then the last bucket, the bucket that we don't need to touch for 8 years, that can be 80% stock, 20% bond. And how much you put into each one of those buckets really depends on your expenses relative to your income and how much of a shortfall that you're going to have. But the idea is with buckets is we're just trying to help you weather the storm, if you will. We're trying to help you create a strategy that keeps you invested, because if we create a plan, if we create an investment strategy and you bail out of it because of market volatility, then we just significantly increase the chances of your plan failing if we don't stick with it. Some people have called this a behavioral trick. You call it what you will. If it keeps you invested and makes the plan work, then it can be a good way to think about how to diversify your money across time segments. Okay, the next thing I want to talk to you about is stocks. So market capitalization. This is looking at the top 10 stocks by market capitalization back in the year 2000. So we had Microsoft, General Electric, Cisco, Walmart, Exxon, Intel, NTT, Royal Dutch, Pfizer, and Nokia. A couple of companies I want to point out to you here. Number one is Intel. Now, Intel, if you'll remember back in the year 2000, we were going through the dot-com bubble, but it was a time when there was extreme euphoria about the potential of what the internet was going to do for us. And Intel makes processors, and who today doesn't have a computer, multiple computers around them all the time? In the year 2000, Intel had a market capitalization of 300 billion. It was the 6th largest public company globally by market cap. The other company I wanted to draw your attention to is Nokia. Now, at the time, if you remember, cell phones had really not been out for very long, and Nokia was leading the charge in the cell phone industry. In the year 2000, Nokia had a market capitalization of 219 billion. So before I go on, I just want to do a quick poll with you and ask you a question, get some feedback from you. Okay, so here's the poll. Of those companies, those 10 companies in the year 2000, the top 10, the question is, how many of these companies are in the top 10 in 2023? I'll share with you the results. 72% of you have voted. 80% of you have voted. One of you, or 33% of you said one, 60% of you said three, and 7% of you said five. Where's the answer? Let's look at what it looks like for the end of 2023. Okay, so here are the top 10 stocks by market capitalization in 2023. For those of you that guessed one, which was 33% of you, Microsoft is the only company from the year 2000 through 2023 that is still the top company. And the reason that I wanted to share this with you, and I'm going to go into more research on this in just a second, but back in the year 2000, like I said, Intel was $300 billion market capitalization. In 2024, Intel has a market cap of 133 billion. It's currently ranked number 107 out of all of the companies. Nokia, remember they had a market cap back in the year 2000 of 219 billion. In 2024, Nokia has a market cap of 21.5 billion. It's number 874 on the list. So my question for you is, when you look at these companies, some of these companies that so many people are so excited about right now, for example, NVIDIA is just in the news headlines again because they're making processors that power artificial intelligence. But of these companies right here, which one of them or how many of them do you think will make it? If we're sitting here 24 years from now, 25 years from now, how many of them will still be in the top 10? What do you think? The point of showing you this is that we tend to tell ourselves stories to justify concentrated risks with individual companies, with individual stocks. And I know there's a lot of you out there that own your Apple and your Tesla and your Amazon and your NVIDIA, and it's been really good for you. But it brings us to this next bit of research that I want to share with you. And there was a study that was done by JP Morgan Asset Management. And what the study did was it looked at the risks and rewards of owning concentrated stock positions. The study looked at the risks of basically the Russell 3000 index, and they compared owning the Russell 3000 index to owning individual companies during that period of time. And basically, if you don't know the Russell 3000 index, it basically covers 98% of the investable market in the United States. And the research that they did was really fascinating. Here's some of the highlights. 40% of all stocks suffered a permanent 70% decline from their peak value. This study, the one that I was referencing here, it's been updated a couple of times, but this one was from 1980 through 2014. And there were 13,000 stocks that had been part of the Russell 3000 index during that period of time. But 40% of those 13,000 stocks suffered a permanent 70% decline from their peak value. 40% of stocks experienced negative lifetime returns versus the broad market. The return on the median stock since its inception versus an investment in the Russell 3000 was negative 54%. 2/3 of all stocks underperformed the Russell 3000 index, and 40% of all stocks, their absolute returns were negative. So this is how you can take investing and turn it into gambling, by trying to subscribe to newsletters, to try to invest in a way where you think you're going to be able to pick the winners over everybody else, over all of the computers that are working against you, over all of the PhDs and MBAs that have devoted their careers to investing, and then the small mom and pop guy at home thinks that they're gonna beat these people and these computers and these algorithms. And the research shows us that that's just not a very realistic expectation. And it's really important that you're telling yourself the right story. And let me continue on with this here. going back to Intel, now most of Intel builds microprocessors, and like I say, we're surrounded by computers. I've got 3 of them sitting on my desk here. The other company I wanted to talk to you about, because that's technology, so some people say, yeah, Jason, technology is one thing, but the other one's Starbucks. Starbucks they're like the #1 most popular, the coffee is a central nervous system stimulant, and some people say it's addictive. And so they're like the #1 pusher of this addictive central nervous system stimulant in our country. But most of us enjoy their products on a regular basis. And I'm looking forward to enjoying more Starbucks come November 7th. I'm taking a 1-year hiatus from drinking coffee. So November 7th was when I quit drinking caffeine. So I'm planning on November 7th of this year. That will be when I decide whether or not I go back to it or not. But the reason I wanted to talk to you about these companies, and now we're just looking at short-term results, but Intel, when I looked at Intel, their year-to-date returns, you see this right here, negative 36% for year-to-date for 2024. Starbucks, great company, year-to-date, and this was as of yesterday, but negative 19% if you own Starbucks year-to-date. And if you compare that with, if you just had a 60% stock, 40% bond portfolio this year, that portfolio was up about 12.5% this year. So the reason I wanted to show you this isn't to beat up on Intel or Starbucks. They're both good companies. They both produce really good products that we use all the time. But the point of it is to say that once you get to retirement or when you're getting ready to retire, it's not necessary to take concentrated bets in individual companies to have a really good strategy going forward. In fact, taking those concentrated bets could actually hurt you. Now, I've got another poll I want to get your feedback on here. In the last 20 years, how often has the United States been the best performing developed market? Let me launch this. So the best performing developed market. So developed markets, of course, the United States is a developed market, Japan, Canada, Spain, Norway, Finland, Denmark, Austria, Ireland, Sweden. How many times in the last 20 years has the US been the top performing developed market? I'll share with you the results once we get to about 80% of people voting. We're currently at 50%. %76%. We get one more vote, a couple more votes. 79. Okay, so here's how you guys answered this. 33% of you said the United States was the best performer 5 times out of the last 20 years. 30% of you said that it was the best performer 10 times. 19% of you said it was the best performer 15 times. And 13% of you said that 20 times out of the last 20 years, the United States was the best performing developed market. So that brings us to our next slide. This is looking at the equity returns of developed markets. And what you will find is that the United States was the #1 performing developed market 1 time in the last 20 years. And it really, what I think this underscores, and by you playing along with me in the poll, is that we tend to all have a home country bias. And sometimes that home country bias can hurt us. And so that's why when we create a broadly diversified portfolio across asset classes, sectors, we also want to be broadly diversified across the entire globe. The hard part about being diversified is we don't know when the United States is going to be the best performer, or when Sweden is going to be the best performer, or when Finland is going to be the best performer, or when Denmark is going to be the best. But what we do know is that by having exposure to all of these markets, it's going to help us reduce the volatility of the portfolio. And I'll show you this in more detail here in just a minute. And again, what we're trying to do is earn the rate of return that you need to earn to have a successful investment experience. And diversification is the only free lunch in investing. So the more diversification we can have, the better. Now, a question becomes, okay, Jason, how do we decide how we're going to diversify across US versus developed markets versus international? And I would say that a good starting point is just to look at the global market capitalization. So right now, the United States represents about 60% of the global market capitalization. So if you were to start with an asset allocation with 60%, allocated towards the US, that would probably be a good starting point. And then including some international and emerging markets in there as well. Now, emerging markets, these are going to be countries, as you can see, we got Colombia, Egypt, China, Peru, Brazil, Thailand, Indonesia, Turkey, Taiwan. And some of the returns here are incredible. Now you have a lot more volatility, and I know that like many people these days, there's real concerns about investing in China with the way that they're acting pretty aggressive towards their neighbors, Taiwan, and also some of the way that they're stealing information from the United States and stealing technology from the United States. And so we've definitely got an issue here with China. But if you've got a broadly diversified portfolio and you have some exposure to China, and you have both US, international, and emerging markets in there, you really shouldn't have more than, I would say, I know in the portfolios that we create, less than 3% of the total allocation is allocated to China. So while you want some exposure to it, and it's hard to say this, but especially you want exposure to it when it's out of favor, which China's out of favor right now, because if things turn around and their government starts to adopt more of a approach to capitalism that's healthy, as they were doing previously, then China could really turn things around and start becoming a more trustworthy ally in the global marketplace. Okay, the next thing I want to talk to you about is factor investing. So in 2013, Eugene Fama won the Nobel Prize in Economics for his work on the efficient market hypothesis. And some of his most significant contributions to investing have been with his colleague, Kenneth French. Both Eugene Fama and Kenneth French are on the board of directors at Dimensional Funds. And Eugene Fama is currently a professor at the Chicago Booth School of Business, and Kenneth French is a professor at Dartmouth University. But basically what they've contributed is what we call factor research. And it's really just a way to organize historical data, try to understand what drives the differences in returns across different groups of securities. And so what this chart shows us is that some of these drivers of higher expected returns are things like over long periods of time, small cap beats large cap. You can see on 10-year rolling periods, 70% of the time, small cap beats large cap stocks. On 10-year rolling periods, value beat growth 80% of the time. On 10-year rolling periods, high profitability beat low profitability 92% of the time. Going back to that pyramid of investing success, once we have that globally diversified portfolio, what we want to do is we want to start tilting portfolios towards some of these drivers of higher expected returns. Let me show you the next slide here. So if we look at these drivers of higher expected returns, one of the things that you want to make sure of as you're trying to decide how you're going to tilt your portfolio is that you want to know that these drivers of higher expected returns are not just occurring in the United States, but they're pervasive across markets. And that's what this chart shows us. So you can see small beat large in the United States from 1928 to 2023. And international developed from 1970 through 2023, it was 13.47 versus 9.08%, small cap over large cap. And even in emerging markets, you can see that small cap beats large cap. Now, the same thing comes to value over growth. So from 1928 through 2023, value averaged 12.53%, growth 9.54. In developed international, again, value beat growth. In emerging markets, value beat growth. Same thing with profitability. So high value or high profitability beat low profitability in the US, again in international developed, and again in emerging markets. So if we have this data, we know that this is truth. We know that these have been long-term drivers of higher expected returns. Why would we not want to incorporate that into the portfolio construction? Why wouldn't we want to tilt our portfolios to include those drivers of higher expected returns? And my belief is that we should, and we do. And that's one piece that you consider. Okay, the next thing I want to do is just bring all of these pieces together and show you why this is so important. Again, I want to take you to a really painful period of time that many of you remember. It was the period from 2000 through 2009. We call that the lost decade. If you had all of your money in the S&P 500, let me show you what would have happened. If you had all of your money, you started with $1 million in the S&P 500, you took no withdrawals, you did no rebalancing, At the end of that period of time, at the end of that 10 years, you had $901,000. You actually lost money if all you had was the S&P 500 index. The next thing is, I said, what if we had 9 asset classes? We were equally weighted across those 9 asset classes. So we put no real thought into how to diversify, but we had real estate investment trusts, the total US bond market, cash, US small cap stocks, global bonds, high yield corporate bonds, US large cap stocks, international developed markets, and emerging markets. So again, during the same period, 2000 through 2009, if you started with $1 million and you did no rebalancing and no withdrawals, you had $1,744,000 at the end of that period. So think about that. If you only had the S&P 500, you had 901,000. If you were equally weighted across 9 different asset classes, you had $1.7 million. Do you see the value of diversification? It gets even better. So now let's say that you're retired, and I know a lot of people are retiring from the federal government. So they have the C fund that they have. That's basically the S&P 500. So now what we said was during this period of time, 2000 through 2009, you started with $1 million, but now we assume that you took 4% out the first year. So you took $40,000 out the first year, and you increased those withdrawals every year for inflation. So you can see you started with $1 million, you ended up with 415,000 at the end of the 10-year period. Whereas if you had that same 9 asset classes equally weighted with no rebalancing, but now we're taking those portfolios, you started with 1 million, you've got $1,153,000. This could be the difference between whether or not you run out of money in retirement versus whether you have enough to make it throughout your entire life. So you really want to be intelligent with how you're constructing the portfolio. Now, one of the things I want to say as we're looking at these numbers, remember, this is all hypothetical, it's actual back testing of data. The purpose of back testing is to help us understand what has happened historically. Of course, past performance is no guarantee of future results, but the past does leave clues. And what I'm hoping to do is just increase your awareness about the value of how you invest as you head into retirement. Because one of the things I know for sure is once you give up that employment, once you give up that work, what you have is what you have. And making a significant or a major error with how you invest right at the time of retirement could be something that you never recover from. Okay, the last thing I wanted to show you is what if we had those 9 asset classes equally weighted, but now we were rebalancing. So remember, we were taking 40,000 out per year adjusted for inflation. We end up with 1.1 million during a really tough 10-year period of time. And now with rebalancing, in this instance, rebalancing actually had you end up with a higher value, 1.2 million versus 1.1 million. Now, I would tell you that the purpose of rebalancing generally is not to enhance returns. The purpose of rebalancing is to help reduce volatility. And I think that's really demonstrated here. So you can see without rebalancing, the max drawdown was 42%. With rebalancing, the max drawdown was 38%. So the idea behind rebalancing, it's really more of a risk mitigation tool than it is a tool to try to help you achieve a greater rate of return. But in this particular scenario, that's the way that it worked out. Okay, the thing I want to do is I want to answer questions for you guys. I thank you for being here. I'll put the disclaimer up on the screen to remind you past performance is no guarantee of future results. Don't take anything we talked about today and go change anything in your financial life based on this information. It's really intended to just be education. But I do want to answer questions while we're here. Many of you were here at the beginning. I showed you how to ask questions. If there's any questions you have, go ahead. This would be a time for you to ask those questions.